Salam everyone. So this is the question pertaining to bad debts and provision for doubtful debt that I am solving in order so that you understand how to implement those concepts that we learned in previous explanation videos of bad debt and provision for doubtful debt. So if you read out the question, Penny Case started a business on 1st January 2006. At the end of the first year in the business, she decided to set up a provision for doubtful debt calculated at 3% of the trade receivable. Trade receivable at 31st December 2006 was amounted to 160,000. So basically 2006 is the first financial year, first business year as well, and at the end of the year her trade receivables were 160,000. Now during the period 1st January to 30th November 2007, now this is the second financial period, Penny Case wrote off bad debt totaling 1600. The accounts receivable, meaning again trade receivable, we can write this as trade receivable, as at 31st December 2007 amounted to 182,000. So basically the trade receivable at the end of the second year, that is 2007, were 182,000. However, Penny Case has not yet processed the following transaction which need to be dealt with. So before reading out all of this, let's jump on to what the examiner asks us. So it's written, calculate the amount which Penny Case should provide as a provision for doubtful debt for the year ended. So what would be the, basically we have to calculate what would be the provision for doubtful debt at the end of first year, then in part 2 at the end of the second year. So we can calculate first year. So basically we'll apply this percentage on the value of trade receivable at the end of the year. So our trade receivable at the end of 2006, as you can see, is 160,000. Out of this 160,000, we think 3% of the receivables wouldn't pay us. So if we calculate 3%, that will be 4,800. So we think $4,800 customers wouldn't pay us in future. So this is provision for doubtful debt at the end of 2006. Now if I calculate for A part 2, so at the end of second year, before processing all of these transactions that is mentioned in 1 and 2, we had trade receivables worth 182,000. The transaction wrote on the line prior to this is Penny Case wrote off debts totaling 1600. So these bad debts were already written off during the year, in between the year, so these are not reflected in trade receivable, meaning to say like 1600 are already dealt, so they are not part of the receivables. So we do not need to deduct 1600 because they are already deducted, because the accountant has already made a record of it. So he has already deducted those 1600 from trade receivable. So we do not need to consider this again and deduct this again. We just need to consider 1 and 2 in order to arrive at the final value of trade receivable. So as you can see, if we read adjustment number 1, as Stepler, an account receivable who owed $5,000, had been declared bankrupt in December 2007. Penny Case received payment of 0.4 in the dollar in final settlement. The remainder of the debt is to be written off as bad. So basically, as Stepler, who owed 5,000, he's being declared bankrupt, but he's paying $0.4 for every dollar he owed. So basically we can say he's paying 40%. So you can work out. So if he's paying $0.4 for every $1, so how much will we get for $5,000? So if you multiply, we will get $2,000. We will get $2,000, right? So other $3,000, 5,000 minus 2,000, the amount that we will not receive is $3,000, and this is our bad debt. So basically, if you see, when S. Stepler would pay us, what would be the entry? Bank would get debited by 2,000 and S. Stepler would get credited by 2,000. And then bad debt would get, in order to record the bad debt would get debited by 3,000 and S. Stepler would get credited by 3,000. This is how we are recording bad debt, right? Now if you look at these two entries, so basically once our receivable reduced by 2,000 because he paid us 2,000, then we declared him bad debt of 3,000, so our receivable also got credited by 3,000. So in total our receivable is getting credited by 5,000, once by 2,000 and the other time by 3,000. So in total S. Stepler is getting credited by 3,000 or 5,000. So hence our value of receivables is actually reducing by 5,000. So because of this, our value of trade receivable would reduce by 5,000. And then Penny Case also decided to write off other bad debts totaling 2,300. So we also have to subtract 2,300. So basically our value would be from 182,000. We will have to subtract 5,000 because of Stapler and also other debts of 2,300. So our final value of trade receivable at the end of second year would be 174,700. And if you work out 3% of 174,700, because we think 3% out of 174,700 wouldn't pay us this amount, so that would be 5241. So our value at the end of the first year is 4,800 and at the end of the second year is 5241. Right? Now key point to note, after we have adjusted trade receivable for all the bad debts and irrecoverable debts, then only you can apply the percentage of provision for doubtful debt. Because if we think about someone who is confirmed that he wouldn't pay us any amount, so we'll have to first remove that amount from trade receivable, and then we'll have to apply the percentage of our doubtful debt, because obviously if somebody is confirmed that he wouldn't pay us, so he's out of our doubtful list. Now the remaining trade receivables are part of doubtful list, so we'll have to apply percentage over them only. I hope that makes sense. As you can see in part B, the following ledgers, so we have to make these ledger account. First one is provision for doubtful debt, and we have to make it for second year, that is 31st December 2007. So basically we have to make from 1st January 2007 until 31st December 2007. For second year of trading, we are making all these accounts. So as you know, as we discussed the format of provision for doubtful debt, it's a contra asset account. So therefore the balance BD of contra asset account would be on credit side. So balance BD would come here and balance CD, and the date would be opening date, which is how much, 2007, 1st Jan, and balance CD would come here, which is closing date 31st December 2007, right? So balance BD reflects provision at start. This I told you, this reflect provision at start. You don't need to mention, I'm just writing it for your information, and this represent provision at end. Now we know 4,800 was the provision at the end of the previous year, so obviously this would be the provision at the start of the next year as well. Like in accounting, 31st December 2006 is the same as 1st January 2007. So we will write provision at start as 4,800, and balance CD would be, as you can see, a provision at end is 5241, right? 5241. And now if you see which side is smaller, as you can see the credit side is smaller, because here the value is 4,800 and here the value is 5241. So we'll take out the total of this side, which is 5241, and we'll also make this 5241. And if I subtract 4,800 from 5241, so 441 would be the value that we will transfer to income statement at the end of the year. So we'll write the date 31st December 2007. And as I told you, if the provision is increasing, so you can see if the provision is increasing, as you can see our provision is increasing by how many dollars. At the start of the year our provision was 4,800, then at the end it became 5241. So clearly we can see our provision is increasing by how many dollars, $441. And if the provision increase, it is recorded and is an expense, and it comes on the credit side of the provision for doubtful debt. That is why the income statement value is on the credit side. I hope that makes sense. Now in part B, we have to make bad debt account. We have to make a bad debt account. We have to make key accounts of bad debt. So probably is first we record bad debt, and in order to record bad debt, we'll have to debit bad debt. We'll have to debit bad debt in order to record bad debt. So first we will record bad debt. You remember the entry, bad debt debit and Mr. A credit. That was our example. So we'll have to debit bad debt with all our receivables amount which we are declaring bad debt. So we'll start. So basically First we'll have to enter this 1600, because obviously how would have accountant treated this bad debt as well? He would have debited bad debt and credited trade receivable. But since we do not know the names of the individual trade receivables who got declared who got declared bad debt, so obviously we can't write down their name. So rather than writing down their individual names, we'll just suffice by writing trade receivables instead of them. If we knew their specific names, we would have written those individual specific names, but now we do not know their names, so we'll write bad debt debit and trade receivables get credited by how many dollars? 1600. And this was entry passed on 30th November 2007. So 2007. So we will debit our bad debt account. As you can see, we debit bad debt in order to record bad debt 1600, and we will write trade receivable as cross reference. Then then at the end of the year, on 31st December, this was 30th November, and 31st December we wrote penny case as bad debt by 300. So we can write how many dollars? Sorry, not penny case, S. Stapler. Penny case is someone who's running the business. S. Stapler was also declared bad debt by how much? $3,000. So we'll write this. And again, some other debts were also written off. So obviously we do not know their name as well. So we'll write just trade receivable 2300. Now I think I'll have to remove S. Stapler so that the bad debt account looks a bit clear to us. So now once we have debited all these amounts into bad debt account, we also have to close the bad debt account and transfer this bad debt account into income statement. And you know the transferring entry. In transferring entry, income statement gets debited and bad debt gets debited. Income statement would get debited and bad debt would get credited. So we'll have to credit bad debt. That is why I will add all of these value and credit bad debt. What's the total of all these value? I think it's 6900. So this would also become 6900. So we'll credit bad debt account, as you can see here, by 6900, and income statement, we'll write income statement over here. This is done as part of transferring entry, transferring it to income statement. As you can see, so the examiner has also asked us to make the account of S. Stapler. So we'll have to record all transactions pertaining to S. Stapler in this account. So basically the question mentions the S. Stapler owed us $5,000, and S. Stapler is our receivable, and you know any receivable is our asset, and the balance of an asset comes on the debit side. So we will write balance BD $5,000 for S. Stapler. Right now, so at the end of the year we'll also declare him as a bad debt, but first he paid us that amount of money. How much did he pay? We can write bank debit and S. Stapler credit by 2000, because he paid us 2000, which we discussed previously. Then we passed the bad debt entry as well, bad debt debit. In order to record bad debt, we debited bad debt and credited S. Stapler by $3,000. So we'll make these two entries in the account of S. Stapler as well. S. Stapler will get credited by 2000, as you can see, and when S. Stapler is getting credited, so bank is getting debited, so we'll write bank over here, and S. Stapler is getting credited by 3000, and since S. Stapler is getting credited, so bad debt, as you can see, is getting debited, so our account gets settled. There's no balance left in the S. Stapler account after we have declared him bad debt. Now the examiner asks us in part C, how would the income statement extract for the provision for doubtful debt and bad debt for the year end the 31st December look like? So we have to draw income statement extract. Income statement extract. I forgot 1 minute. Basically income statement extract. We have to write this. So we'll plug in the headings of expenses, and in expenses, you know, we will write, because our provision is increasing, and the increase in provision, as you know, is 441. This is our doubtful is an expense. Increase in provision is an expense. So increase in provision for doubtful debt, how much? 441. And then we will also write bad debt we can look at the account of bad debt, how much amount did we write off as bad during the entire year, which is 6900. So 6900, this is how would the extract would look like. Then the examiner is also asking for the SOFP extract at the end of the financial year, and so you will write the heading of current assets, and in current assets you would write trade receivable. But before writing the value of trade receivable, you will have to remove bad debt. So what's the value of trade receivable after removing bad debt? You can see we already worked out that value. I think we subtracted from 180,000, we subtracted 5,000 and 2,300. So our remaining value of trade receivable on which we applied percentage was 74,700. So our value of trade receivable after considering all the bad debt is 174,700. Then we will going to deduct provision for doubtful debt at the end of the year. So at the end of the year, provision for doubtful debt, as you can see in the account, is 5241. Also this would be balance BT as well for the next year. So 5241 gets deducted, and if you want you can net it off as well to show the examiner what's the value left after you have adjusted provision for doubtful debt. Thank you. That is it for today.